Hello everyone, welcome back to our channel. I am Hema Holevasur, mentor, trader and a financial analyst of Shakti Institute of Financial Market. So today's topic is about the 10 rules for successful long-term investing. So before we start this, please share and subscribe our video. And if you want to enroll our courses, you can visit to our website, that is www.sifminstitute.com, and you can see the blogs over there, and you can see varieties of courses are there in that. So if you find any difficulties in enrolling our courses, you can call us anytime. We are here for your services. And if you want to join the offline classes, then the next batch will be starting on 2nd of August. So you can join our courses offline also. So let's start. So first, before we start, is long-term investing better? See, investment are of different types of investment are there. Like you can invest in stock market, you can invest in banks, FD, and then you can invest in bonds, you can invest in other multi assets. So there are varieties of investment, but today we'll talk about the stock market. So whether investing in stock market for a long run is good or for the short run is good. So here there is a line: in short run, the stock market is like a voting machine, and in long run, it's like a weighing machine. So what it's is in short term, what happens is there are many varieties of companies where you will invest and you will come out very fast with a less profit. So it's like a voting machine, and you won't do any much analysis for that. You just invest, and you just invest for the short term, and you just sell it uh, with a minimum profit. But if you are a long term investor, then you do lot of analysis before investing in that, and it will create a wealth over a period of time. So it is heavier than compared to the voting machine. And if you want to invest in stock market, you should have a thorough knowledge. You have to put in very much efforts to grow your money, and the success will not come overnight. For that you have to wait patiently. So in stock market, if you are a long term investor, then patience and discipline is the two important thing which you have to follow. If you don't have that, then you won't be successful in long term investing. And in stock market, if you are a long term investor, then definitely your wealth will be created. There are many examples, like you know about Warren Buffett, you know about Junjunwala. There are many other investors who have gained their appreciation or gained their money over a period of time. Fine. So let's see some of the rules which you have to follow if you are a long term investing. Invest, don't speculate. See, if you're a long term investor, then just you invest and forget it. Invest in a good company and forget it. You will get a very good return. Okay. And if you're a speculator, then you will get a speculator's result. That is, one time loss will be there, one time profit will be there. So overall, the growth compared to the investors will be less in speculation. Fine. Then next is the know your type. So you should know whether you are the full time, you will give time to the for the long term investing, or you don't have time for that, or you can manage both. So it depends totally on you. If you're a full time long term investor, then you need to put in some effort, and you should expose more of your investment into the stock market and less into the banks and bonds. Okay. So if you don't have time, then better go for the bank FDs or bonds, because there the risk is less compared to the stock market. And the your portfolio should be the mixture of mid cap, small cap, and the blue chip companies. Fine. Then what will happen? One or the other market will be moving up. Sometimes blue chip companies will be moving, sometimes only mid caps will be moving, sometimes only small caps will be moving. So your portfolio should be the mixture of all these stocks. Yes, and mentally be prepared for the big disturbing decline in your portfolio every few years. Yes, you have, if you're a long term investor and if you're into the market for over a long period of time, then you have seen many markets disturbing. In 2008 there was a recession, and then last recently the covid had come. That time also the market had corrected 50%. So that time what has happened, your portfolio has declined like anything. Valuation of the portfolio have declined like anything. So don't be panic if the market is coming down. Okay, so mentally be prepared for that. The next one is know the difference between the timing and the pricing. Yes, so when to buy and when to sell a particular stock, that you should be knowing. Okay, and the pricing in the sense intrinsic value. Every company have the intrinsic value. So up to what extent that particular company will go. For example, if Tata Motors, if you take now, if you I am taking one example, if Tata Motor is going up to 800 rupees, so you have to buy at a lowest level, that is around 450 400 range. Then what will happen, you have the potentiality of upside up to 800 rupees. So you have to see the pricing also before you invest in the stocks. Okay, and when to sell and when to buy, you should be knowing it. And always don't put all the eggs in one basket, keep diversified. Yes, what happens is each everyone usually what they do is they buy only one particular company, invest all the money in that. Don't do that. If that particular company comes down, then your total valuation will come down. So keep diversified, like in IT, and then in pharma sector, then in engineering sector, and then the FMCG sector. So divide your portfolio in different sectors, banking sectors. So what will happen is one or the other sectors will be booming. So in that time what will happen, some of the your portfolio will be down and some portfolio will be doing very nice, some of your stocks. So the overall your portfolio will be in the profit. So don't put all your money in one basket. Fine. Then always look for margin of safety in valuation. Yes, always buy the stock the which is at a low, quoting at the lowest price, because the if the intrinsic value is less and if you buy the stock, then you will end up with a loss. So margin of safety is the central part of the investing in long term. Okay, high growth companies don't always make good investment. Why it is so? Why this high growth companies don't always make good investment in the sense, because the high growth company, the prices have already moved up, and if you enter at the higher prices, then it will lead to the your loss in your portfolio. So the overall portfolio will come down. So if you want to invest in this high growth companies, then enter at a very attractive price. Okay, and then the next one is don't ignore the past performance of the company. See, whenever there is a market correction and you have invested in a very good company, by seeing all the financials of that company, you have done the very good analysis of that company, you have seen the ratios, you have seen the financials, you have seen the balance sheet, everything you have seen, and you have invested in particular company. If the market comes down, don't worry. If you're as you're a long term investor, just see the past performance of the company. You can see the history of the stocks mark prices also. If it has achieved some price, then again it will definitely go to that price. If it has come down also, so it has a memory and it will go back to that price, higher price. So and if that company is a growing company, then definitely it will go up. Okay, so if you have invested by doing all the analysis, then just don't worry. Don't Next one is do not pay much even for a good quality stocks. Yeah, this is what the quality and of the stock is very good. But if you pay too much high price, then you are exposing to a big loss in your investment. So wait for the correct price and then you enter. Okay, so remember, the price is what you pay and the value is what you get. Value should be always greater than the price what you pay. Fine. So if, even though it is a good quality stock, see now Infosys is good, TCS is good, IndusInd Bank is good, HDFC Bank is good, Kotak is good, and Tata Steel is good. All are good companies, no doubt in that. But always enter at the lowest price, as the price is what you pay, and always exit at the higher price because the value is what you get. Fine. And always take care of the downside, and the upside will automatically take care by itself. So here you have to remember that whenever there is a downside, many investors are there who will just exit, and they'll say that the stock market is not good, we don't make money in that. Why it happens to them is they don't have the patience. So always whenever there is a downside, if it is a very good company, then you can do averaging, but never exit with loss. If you hold there patiently, then upside will definitely take care of you by itself. Because when, if the market has come down by 20 or 30%, then the upside will be 50 to 60%. As you have seen in many cases, in many times, whenever the market has crashed, the double triple it has gone. Fine. So don't lose money, rule number one. And rule number two is always remember rule number one. That is, don't lose money. Fine. So this is about the today's video. And if you enroll, if you want to enroll our courses, or if you want any guidance on your on the investment, then you can contact us at 9686199524, and you can visit our website, that is www.sifminstitute.com, where you will get all the courses, and even the blogs are there, so you can read our blogs. So, and please share and subscribe our channel. Thank you for watching our video.